Welcome to Investing for Generational Wealth. I'm John Lai from XSITE Capital, where we help high earners just like yourself invest outside of the traditional stock market to passively achieve long-term wealth generation through superior risk-adjusted returns, long-term passive income, cash flow, and tax benefits. And together with investors, we're renovating over 900 apartments and building over 500 single-family rental homes. And then we're also expanding beyond that to alternative assets, such as debt income funds, commercial triple net real estate, as well as oil and gas pretty soon. And so before we begin, a quick disclaimer, like always, we are not financial advisors. All investments are subject to risk and, of course, possible loss of your money. Please do your due diligence before making any financial decisions, and consult your CPA, your lawyer, and the like. So I'm your host today, John Lai from XSITE Capital, and today's episode is really great. It's acquiring your first apartment building. A lot of us who have acquired our first apartment building know kind of that sensation. And today's guest is Leslie Awasom. Leslie is the Director of Operations and co-founder of XSITE Capital Investment, where he oversees company operations. He does market and data analysis, cash flow and budgeting. And he is a dedicated entrepreneur. He has an amazing journey, founding an e-commerce company, a wellness clinic in Baltimore, and training as a nurse anesthesiologist or anesthetist, rather.
Yeah, you got
Leslie,
it.
before I butcher it anymore, do you want to give a little bit more of your background and how you got to where you are today?
Sure, absolutely. Thank you so much for that amazing introduction, by the way. Like you said, my name is Leslie Awasom. I'm one of the co-founders of XSITE Capital Investments. Just started off like everybody else as a busy professional. I'm a nurse anesthetist by training. I was a nurse anesthetist for 9 years before this year. I officially left my position to focus full-time on real estate investing. But I was just a nurse anesthetist, going through what most of us busy professionals go through, which is the burnout. After putting in all those hours and realizing that there's that limit to the growth when you're trading your hours for dollars, I started looking to find alternative ways where I could create income and build generational wealth for my family. I came across real estate investing, learning that a lot of millionaires have been made through real estate investing. So I was like, that's what I want to be too. So let me get into it. So I started in single family investing in 2017. Met my two amazing partners, Dr. Julius Oni and Tenny Tolofari, and we co-founded XSITE Capital in 2019 to really be of service to other busy professionals like ourselves, understanding that if we're going through that same kind of burnout feeling and looking for financial freedom, there are many others like us that want the same thing. So our platform was created to serve that demographic, and it just took off from there and grew to where we are today. So I transitioned immediately from single family. Actually did one deal and then transitioned. For me, what made me make that transition is more on the number side of things. I'm a logical person, and I think my training in anesthesia also reinforced that. Because in anesthesia, we are trained to figure out everything that can go wrong in any situation to prevent it from happening. So very risk adverse in my approach to investment. So when I studied multifamily and I saw it from the numbers perspective, understanding how multifamily assets are valued and seeing how that applies to the regular day life, like you actually investing in an asset that caters to a core human need, right? It's a need that is not going to go away. People always need a place to live. And then looking at the numbers from the numbers perspective, just from a basic principle of economics of demand and supply, understanding that there's more demand for these assets than there's ever going to be supply just made sense, right? And then single family, I had some exposure to single family both as a buyer and as an investor. And understanding how those are valued versus how multifamily assets are valued. I think the valuation of multifamily assets was that formula of understanding how multifamily assets are valued that hit home for me. And I was like, oh my God, this actually exists. And these assets, you could buy these assets. And if I don't know about it, how many other busy professionals like myself don't know that you have access to this? So that was the motivation to move straight to multifamily investing.
Now, how did you gain your experience? Because I go back to like my experience with multifamily and
Mhm.
just with commercial real estate, and it took some time, right? There's a lot of, and especially a lot of us that are, educated, that probably too analytical, right? And
Yes.
so, like, how did you learn what you learned, and then did you apply what you learned right away, or did you take some time and maybe analysis by paralysis? And I'm guilty of that as well.
Oh no, that's an amazing point. Analysis paralysis is real, and what I've come to learn in my entrepreneurial journey is like actually a lot of us that are educated, that are intelligent, like we suffer from that a lot, right?
Right.
Our overexposure and over education can actually be an Achilles that holds us back from taking action because we want to look at everything from every single angle before we move forward. And a lot of times the data that we're using to make these decisions is not necessarily correct because we haven't been exposed to that. We're using very limited knowledge to make decisions that hold us back. For me personally, I got to tell you the truth. If it was left to me alone, I probably would not have started till about 3-4 years later. I was just so blessed that I had some amazing partners that are a little bit opposite than I am. I'm more of the critical thinker, analytical person. One of my partners, Tenny Tolofari, is like fire, then aim later. So
Right,
he's
right.
go go go. So, so he pushed me a lot out of my shell. So that mixture, that dichotomy of like somebody that is more reserved, more analytical versus him that is like more outgoing, that kind of we kind of pushed each other out. Then Dr. Oni too was more outgoing and more pushful, so that helped me get out of my shell and be able to take more action and to do things. And the more I did the things, I realized that a lot of the data that I was using to come up with a reason not to take action was actually faulty data because I wasn't actually using data based on experience that I had. And one of the things that we did, one of the things that really helped us early on in our journey is like we invested in ourselves to reading a lot of books. We identified other people that have walked down that path before us, and we hired them as mentors, right? Learn from
Right.
their mistakes. And because the way I looked at it was like, I'm a busy professional, I have a high income, I have a high earning job. Now, do I want to spend 4 or 5 years figuring
Right.
this out on my own, learn from the mistakes, or I just invest a specific amount of the income that I have and buy the most valuable asset, which is the time, right? So we went for that route, plugged in with some really experienced mentors, and they really accelerated that journey and helped us grow really fast. And then every point throughout the journey is like constant education, constant learning, constant getting better and taking action. Actually, the best education is taking action because you're going to learn more from that than sitting back and trying to figure it out or analyze stuff.
Yeah, that's a great point. I also remember going back, and I was probably analysis paralysis for about a good 3 years before I met Kishab, and then we decided to jump in together. Uh, we also relied on mentors and the built to rent side, and we really didn't get into multifamily until a little bit later. And then I took some courses on mentorships on commercial real estate, triple net. Um, there's a lot still to be learned, right? Even
Oh,
as you
absolutely.
learn from mentors, how do you make that mental leap? Did you go in as a LP initially, and then or have you jumped to the GP status at this point?
Oh yeah, started off as an LP. Our first investment was an LP. Then we did like a co-GP where we raised capital and then got a little bit of role on the management side. But right now we actually lead our own assets. We actually
Okay.
go find we do everything except for the property management. We identify the assets, underwrite the assets, take it under contract. We are lead sponsors on our run the asset management on our deals, and we raise capital as well for our deals. We partner with other people as well to buy these assets together. So we do it all right now. But started as an LP because I fundamentally believe that it's almost impossible for you to go present and sell something to somebody that you do not truly believe in it. So that whole experience of investing $50,000 and then getting a quarterly distribution, like having that experience, that conviction that, oh my God, this works, was very powerful for us to go out and be able to present these opportunities to other investors.
Yeah, that's great. And I felt the same way as well. Like we don't necessarily do a whole lot of GP at this point. We find that it's much more valuable from our perspective to stay, the LP capital raisers, because that then affords our audience, our investors, with much more opportunity to invest in other things besides multifamily. But how did you pick the asset class of multifamily, and have you stuck with it? Are you continuing to stick with it in this market?
Absolutely. We pick multifamily because of the numbers, right? And one of the things that we truly believe in is focus, right? The market has been crazy, but I actually have a deal right now that we're raising capital for, a really great deal, because what we're finding is, like, in this climate when everybody's afraid, like where the sentiment is like blah, everybody's down. We're seeing some really incredible opportunities, and the only way we're able to see those opportunities is because we stuck with it, right? Over the last 2 years, we on the road, we reviewed about 2,325 deals, like 2,325 on the road, hundreds of them, right? Before we were able to find this one deal that made sense. But in this same climate where everybody is like, oh man, things are going bad, everybody's focused on the politics and the elections and all of that, something crazy is happening, something amazing is happening. Like all these funds, it's crazy. Like all these institutional funds, you're hearing they're fully capitalized on multifamily. They've raised $50 billion, 30, $70 billion, and they're going into the market and they're scooping these deals. It's not that transactions are not happening. Transactions are not happening from traditional syndicators that we saw in the past. All the institutions are in there buying deals every single day, right? Because how I know how I came into this realization is because on this deal that we have, we actually got approached by a few of those institutional investors to bring in some kind of a capital on the deal. And you're going in these spaces and learning. And these guys are very active. They're scooping up all these deals because the sentiment is generally bad. But then they're getting it at a huge discount. Now, when the market sentiment changes, they're going to be exiting out and doing very well. And hopefully, we'll be right there with them too, because we've stayed the course. We've stayed focused on that. We have an entire team focusing on finding these assets, underwriting these assets, and finding the ones that make sense for the current climate.
Now, those institutional investors, are they bringing the deals to you as well as the funds?
No, they bring funds to deals. Most of the investors we've spoken to, they like a lot of off-market deals. They love deals like with a special story behind it. So they mostly bring the funds, and a lot of them want to be they come in, they're bringing significant amount of the funds in the deals. They're still on the management side, but mostly silent, just observing. And then they let you manage the deal, and they make a ton of money from it too. So there's a lot of capital coming back into multifamily right now. And I personally believe, based on what we've seen over the last 2 years and what we're seeing now, like now is probably one of the best times to get in this business.
Yeah. I agree with that. To some extent, I think there's the last 5 years was like really frothy for multifamily. Like everyone's trying to get into multifamily syndications, and so and everyone was doing well because of the market, right? Like as the interest rates were going down, everyone was doing well. They started creeping up again in the last 2-3 years, and then like the short term funding bridge loans came due, and so that's where some multifamily vendors or syndicators came into some trouble, right? Because then they didn't project that, or maybe they didn't fix those bridge loans, right? Fix interest rates, those bridge loans, and so and they couldn't liquidate their funds fast enough, or their syndications fast enough. So I think the smart ones, the conservative ones, have done well, and they continue to
Yeah,
do well.
yeah.
And I think I'd be interested in kind of your mindset and then your buy box. Like what does that buy box look like?
So right now we're focusing on stable assets. These are assets that actually cash flow from day one. We like B plus assets with some minor value add component to it, and depending on the market, right? We go for larger assets, 100 plus units. The larger, the better. Around the 30 to $50 million range. Those are the kind of assets that we look for. And for us, the fundamentals, a lot on the fundamentals has not changed. Like the location, the market, very important for us. We see this current climate as an opportunity to really buy some good assets in strong markets that have strong fundamentals to grow over the next 10 to 15 years, right? Again, a lot of this is like a long-term investment. For example, a market like Atlanta or Charlotte, if you look at the job growth, like the economic development, the projects that are in the pipeline, that are still in the pipeline, right, is significant for the next 10 to 15 years. But in some of these markets experience a little bit of oversupply from all the new product that's coming. You talked about the bridge loan issue. A lot of developers are facing some of those issues as well. So they're discounting their assets, right? But the fundamentals have not changed. The short period of like the crazy interest rates, the loan and all of that affected
Right.
some of these assets, but the fundamentals of that market have not changed. The growth trajectory of that market has not changed. So this is just a temporary period. So we see it as the great opportunity to go in those markets, find really nice neighborhood, buy assets at a discount because the general sentiment in the market is negative. Buy it at a discount and make sure that the business plan is at least 5 years and hold on to it and hold on to it for a good period of time. But an asset that's cash flowing, that has opportunity for growth, that's what we like. I know there's a lot of interest right now, especially from the institutional buyers on distressed assets, like all those bridge loan deals, all those deals that had issues and stuff like that. A lot of institutional buyers are going after such assets, but we are focusing on buying stable assets at a discount in good areas. So that's what our buy box is right now.
Got it. Okay, thank you for that. Do you see that it's changed at all based on some market dynamics, whether it's the interest rates going up a little bit? I mean, obviously it's come down. Who knows what's going to happen in the future? But interest rates, you talked about insurance, that's definitely impacted the market.
Oh yeah.
Or maybe like the population dynamics, and certainly like the not that we're going to see this for a long term, but the election, right? There's a lot of
Yeah.
election and ambiguity in the last month or so, and then once the election happens, then it'll clear up the ambiguity. But like, what have you seen in the market impact those market dynamics?
So it's exactly what I was explaining to you earlier. It's like the negative news cycle that we're in, like the polarization that is all over, right? Where it's like, do you on this side or that side, or the world is coming to an end, these people are going to go to war and all this other stuff. Like I actually had an investor reached out to me in panic that she thinks there's gonna be a civil war that breaks out in a few days and stuff like that. I don't listen to the news, so I don't pay attention to that stuff. So that finally hit me. I was like, oh my God, there's a lot of negativity going out there. And that is what you see. That's why people are like, hey, I'm not investing, I'm just holding on to my money. But if you really want to be successful, you follow, and that's one of the most important lessons I've learned in my journey is like, follow what the bigger guys are doing, the successful investors, all these funds. So I promise you, they are super active right now. They are way more active right now than they were 3 years ago when the retail investors were active, right? They are jumping in right now, scooping in assets. They have raised up all these funds and billions upon billions of dollars. They're buying these assets at expanded cap rates. Now, cap rates have expanded. In some markets, we've seen a 35% decrease in prices from where it was at the peak, right? So there's that opportunity out there that we're seeing right now. What we're seeing mostly in the market, we are probably one of the few groups that are still active, still underwriting deals, still looking at deals, and currently raising capital for a deal right now. Most other groups are sitting in the sidelines just waiting to see what will happen over the next few months. But we stay active. Our philosophy is like stay active, stay in the market, make adjustments based on the time, and stay true to our fundamentals when it comes to the numbers. So yeah, so we, again, like I said, we see this as a good opportunity for us to buy good assets, and we have a really good one that we are taking to the finish line there soon.
Okay, got it. So we do have some investors that are not very knowledgeable about multifamily, about commercial. So the question came up, what is an LP versus a GP? And maybe you can go and talk a little bit about that. What's a syndication, right? And then at some point we'll get to like, how do you do that transition from a single to multifamily? Yes, you can hire a mentor, but like what's maybe like step 1, step 2, step 3? I think that's of interest. Or do you jump in as an LP first and learn the ropes? And then prove your worth or prove your value to a GP, and then you join their team. So
Got
first
it.
of all, like what's an LP versus GP?
So LP is a limited partner, and an LP is a passive investor. So as a limited partner in a syndication, you are not involved in the day-to-day management of that asset. So being an LP is like an ideal position for a busy professional that is just looking to create passive income in real estate, but doesn't want to be a landlord, because there's nothing passive about being a landlord. Trust me, I've been there. There's nothing passive, but this kind of a structure allows you to be truly passive. And this is done in a syndication. A syndication is pretty much, just think of it as a group of people coming together to buy an asset, right? That asset can be an oil field, it could be land, or it could be a large apartment complex, which is what we're focusing on. When the syndication is formed, you usually have the general partners, which is the GP. These are the people that manage the asset. These are the people that get the debt on the asset. And these are the people that are involved in the day-to-day management and make sure that the limited partners, the LPs, get their returns that is promised to them. So most syndications are usually structured maybe like 70-30, meaning the LPs own 70% of the entity that own the asset, and the GPs own 30, or it could be structured 80-20, with the GPs owning 20% and the LPs own 80% as well. So
Right.
I hope that answered all the questions.
That does. And then sponsorships, like we talked about sponsors, like who is the
Yes.
sponsor in a GP?
Yes. So in a GP, the responsibility of a GP is to go find the deal, secure the debt, like the loan to acquire the deal, and then build a team to manage the deal, and then report to the LPs on a monthly basis. So to secure the debt to buy these assets, you need to have a net worth that is equal to the value of the asset, and liquidity that is up to 10% of the value of the asset that you're buying. So sponsor, loan sponsor, or KP, or key principal, is somebody that qualifies, that brings in their checkbook, right? I have $34 million in assets, and I have maybe $15 million or $10 million in liquidity. So now I qualify to be able to get that loan. For us at XSITE Capital, we have a dedicated KP, a partner that we use that comes in and becomes part of the general partnership. His role is to bring his checkbook and his liquidity to the table so that we could secure the loan. His name goes on the loan as long as our names to go on the loan as well. So that's a sponsor for the deal on the GP side.
Yep, that's great. Thank you for that. Keep those questions coming in. We love those questions. One question that you might have gotten from prospective investors is, how do I identify a good syndication, a good GP to invest in? And like how there are multiple investors out there. There are multiple asset classes, and then within each asset class, there's regions, right? And then there's sizes. How would you go about assessing like a particular GP, and then like narrow down your niche as an investor to decide like who you want to go with in terms of GPs?
If you had asked this question to most syndicators or real estate investors 3-4 years ago, They would have told you to identify a good deal, go to the location, and then you look at the property, then you look at the sponsor. But after everything that has happened over the last 3 years, the number one thing you want to pay attention to is the sponsor. It's like who that GP is, who that lead GP is. And there's nothing more important in a business partner than the character of that person, right? Like they say, the way what somebody does one thing is the way they do everything. So what we've seen over the last few years is like even some very experienced sponsors, people that have been in real estate for a long period of time, they fell down the bridge loan debt trap and they lost a lot of deals. And then you saw some issues where they're not communicating well with their investors and all of that. You know, for me personally, what I learned is like the people, the sponsors that value that investors, what's their motivation for becoming for getting in the business in the first place? Who are they truly looking to serve, right? Do they have skin in the game, right? Like like for example, I'll give you an example. Like we're buying this deal in Georgia. I'm investing in the deal in Georgia. My brother is investing in the deal in Georgia. My sister is investing in Georgia. I'm investing for my kids in the deal in Georgia. So you have skin in the game, right? Majority of our investors are people that we know, like, and trust. So all of that goes into the decision-making process, right? Because of the investor base that we have and the people that we serve, we were very, very careful in the kind of deals that we went into. Like the bridge loan era where everybody was jumping in and getting a bunch of deals with crazy bridge loans and all of that. We were super careful, right? Because you know the people that you serve and all of that. So that kind of saved us from a lot. And that is why I look back and I say, one of the most important things that you want to focus in on is who the sponsor is, what is truly their motivation, who are they looking to serve. And then, talk to other investors, people, ask for references for people that have invested with that sponsor, because the deal can go bad, right? But what would the sponsor do when the deal goes bad? That is the most important thing, because the actions of the sponsor can save the deal and save the rest of the investors, or the action of the sponsor can completely destroy the deal. I say this because I know sponsors that have struggled with deals and that have pulled out their own personal funds, hundreds and hundreds of thousands of dollars, to keep the deal afloat, right? So when you hit that kind of a situation, what would your sponsor do? Does the sponsor has the character to do that, or they're just going to let it slide? So I think one of the most important things that you really want to focus in on is a sponsor. And once you find a good sponsor, build a relationship with them, work with them on a long-term basis, because this is truly a long-term business. It's not a get-rich-quick scheme. And when done right, when you partner up right with the right group of people, you can do really, really well. Yeah, I've seen it happen, and we have some investors that are doing really, really well. And I'm just grateful that I have the opportunity to be able to give that kind of value to other people.
That's great. Thanks for that answer. I think that's a perfect answer. The flip side of that is like what to watch out for. Like, what are some red flags? I've heard like capital calls are red flags. Like if you a capital call is, well, maybe you can explain what a capital call is, and then like what are some other red flags to watch out for?
So I would not necessarily call capital calls a red flag or like to no go, because I'm a student. I'm a consistent student. I'm observing from other experienced sponsors, and I've seen some experienced sponsors do capital calls as well on this in this climate. Because a capital call is when you get in a syndication. When you invest your initial capital, most investors expect that my initial capital is in, I'm just going to sit and expect and get returns, but then if something goes bad and that business needs more money, then the GP, the general partner, issues a capital call, which means that every member of that entity that owns the asset has to contribute some more capital to keep the business afloat, right? And that is shared amongst all the people. And there's been an abundance of that over the last year or so, because of those deals that he explained that had floating rate debt, and the interest rates on those debts increased, and insurance costs and everything that happened, and the properties were not doing well. So a lot of sponsors had to do capital calls. Thankfully, we've never had to do that. And again, I do believe that the reason is because we're extra careful going in to buy those deals, just paying attention for the people that we serve. But there's some good sponsors that did capital calls, right? And again, look at the story, look at what's behind that, and see what did they contribute more capital to the deal as well. What did they do to save that deal to keep it afloat? And some of the deals that have done capital calls on might actually do well later on, but you want to give a second thought, like think twice if you hear somebody had a capital call where they're being too aggressive and all of that and stuff like that, and just do red flags, character red flags, right? There are people that have taken other people's money and ran away with it. Look at that. Most of us, before we get in this business, or at least most people, you have some kind of professional background. What profession is that person from? What is their reputation from the professional background? You want to look at that as well. Then once you look at the person as well, you also want to look at the fundamentals of the deal and the market, right? Because I could be the best, nicest person in the world, the greatest, most trustworthy person, and I go buy a bad asset in a bad market, and it's going to go down no matter how good I am, no matter how much I try, no matter the amount of effort that I put in, right? So once you have identified a sponsor, a good market can save a bad asset, right? And even a bad sponsor. So invest in markets that are growing, population growth. Remember, it's a business, so we focus on demand and supply. Always look at demand and supply. What drives demand? Population growth. More people moving into this market, it means there's more demand for living spaces. So you want to invest in those kind of markets. And then you want to invest in assets that have a clear story, a clear path to growth. We do value add, which means that we add the value of the asset by doing some kind of renovation. If you see a value add business plan, is it proven, right? Are there already units in there that have been renovated that are getting those rents? Or are there neighboring units that are getting the rents that are projected? And you want to see that the sponsor is not being overly aggressive on like growth numbers, rent growth numbers, especially now with rent growth kind of declining or staying flat. Yeah, you want to see that factored in on there as well. So, and again, and there's more to the numbers that we could go into. That's like a whole separate class, which I don't want to go too deep down that rabbit hole and get some of you lost because I love talking numbers. But look at the sponsor, look at the market, then you look at the deal.
Got it. Okay, that's great. A question did come in about bridge loans. Like, what is the bridge loan issue, and how prevalent is it these days? And sure, the bridge loan, I would say the bridge loan issue really started 2021-ish timeframe, when interest rates that were at the 3%, jumped up steadily to about 6%. People before 2021 got into floating rate debt, right? Floating rate debt allows banks to adjust that debt, right? And those bridge loans typically are either floating rate or fixed. And a lot of people a lot of syndicators who created, these investments opportunities prior to 2021 would have gone in thinking that the rate would be held steady. And so they didn't fix their rate. And so those bridge loans are loans that are 5 years, maybe 7 years in length, and they'll be floating. And so when the rates started going up in 2021, they were caught with 3, 4, 5, 6, 7, 8, 9% rate debt. And so that was not modeled into their initial assumptions, and that's what got them into some trouble. Any more on that, Leslie?
No, you are absolutely spot on. So bridge loans are typically loans that are given to like development projects. Developers love bridge loans because it's short-term loan. So the interest rates on these short-term loans are floating. You could typically buy something called a rate cap, which is an insurance policy on the interest rate so that it does not float past a certain amount, a certain level. But those rate caps usually last 2 years or 3 years. So what happened is like when the Fed cut interest rates down to 0 with COVID, the value of these multifamily assets skyrocketed. They increased. The reason why they increased is because one of the biggest expense in multifamily is like the debt, right? It's usually about 70% of the value. So 70% is the debt. So if the debt is that cheap, right? Capital cost is cheap, the values go up. When debt becomes more expensive, capital cost is higher, so the values come down, which is what we've seen over the last 24 months. So when the values went up, the traditional lenders, which are government agencies like Fannie Mae and Freddie Mac, stayed disciplined. and they would only allocate maybe about 50% leverage or 60% leverage to investors. Then in came in the bridge lenders. These are lenders that traditionally lend to developers, right? So now they came into the market and started giving these bridge loans to multifamily investors. And a lot of the investors were buying these assets with bridge loans, putting in a 2-3 year interest rate cap on it because the Federal Reserve was saying there is no interest rate hike in sight anytime soon.
Right.
They were reassuring that interest rates are going to stay close to zero or close to zero for a long period of time. And one of the biggest lessons is never trust the Federal Reserve. So but inflation went out of hand, and they had to do something to control inflation. And what they had to do was to increase interest rates. So they went on like a record interest rate hike spree, which rates went from 0 to 5%, like the Fed fund rate. So you had an owner that had a bridge loan with an interest rate of maybe 3% cap, with an interest rate cap of an additional percent. So maximum rate is 4. And that cap expires just when interest rates have doubled. So your debt cost changes from 4% to 9%. So imagine having a loan, a $30 million loan, and your interest rate increased from 4% to 9%,
Yeah.
right?
Yeah.
So that completely kills the deal. And those are some of those assets that are coming to market right now at cheaper prices. And those are some of those assets that are forcing the value of multifamily assets to drop. And which is the reason why a lot of institutional investors are rushing in and scooping some of these assets. And that's one of the reasons why we are very, very aggressive and very active in the market trying to find good deals.
A question did come in, and I'm just going to read it because it's pretty lengthy. Say I'm a GP and I find an apartment complex for $10 million. How is the capital that will be funding the deal broken down? Does the sponsor typically buy the whole thing cash? No, that's typically not the case. Or are they putting down a down payment? Or is the deal funded by all the money from the GPs and LPs combined, and the sponsor acts only as a co-signer?
So with that, so the question is, if you find a deal that is $10 million, you're trying to understand how much money you need to bring in as the sponsor or an investor. And the good rule of thumb is estimate that you have to bring forward anywhere from 35 to 40% of the total value of the transaction. So let's say if it's a $10 million deal, you want to conservatively say you're probably going to need about $3.5 million to $4 million. And that's because the down payment might be 30%. You have other fees like the financing fees. You need to bring in some funds and put them in reserves. You need to have some funds in reserves as well. You might need to do some renovations as well. And you might need to pay some other fees. So what we see is usually anywhere from 35 to 40%. So you're probably going to need to have $3.5 million or raise that from investors. You could bring a group of family and friends and syndicate that as well and go after the $10 million building. But it's definitely a great business to get into, definitely a great investment to get into long term once you understand how to do it correctly.
And I know the answer to this, but why don't banks lend 100%, right, of the value of that particular investment, the 10 million? Why don't banks lend the entire 10 million?
Yeah. Well, if I found a bank that could lend the entire 10 million, I'm gonna take a
Right,
tent
right.
and I'll be sleeping in front of that bank like I'm shopping for a new Apple product. Because
Yeah.
at that point, if then the bank is taking 100% of the risk, right?
Correct.
And they're relying 100% on like the goodwill of the sponsor or the manager to execute on that business plan correctly. So there has to be some skin in the game, right? So the bank will bring in some of the capital and they're bringing it at an interest rate, which they're making money from it. But the fact that you're bringing in some of the funds, at least it decreases their risk as well. So it won't make sense for a bank to give 100%. Although there are some other institutions or some other forms of lending in real estate where that happens. But there's another collateral that holds on to that debt and allows you to be able to get that kind of funding.
Yep. And so at the $10 million mark, what I'm trying to say is at some point, it makes sense to raise equity, right?
Oh, yeah.
Rather than contribute all of your money. At $2 million, $3 to $4 million, a KP or a sponsor could probably contribute all of that in conjunction with the GPs, right? Or you could raise from a small equity group, right? Call it 10x of that, $100 million. They'll likely go out and raise the money rather than contribute that money themselves, because they want to, use other people's money. Leverage is great, both on the debt side as well as on the equity side. And they also want to give investors a portion of that, potential profit margin, right? So for all those reasons, I think it makes sense to go out at some point, and it really depends on if you have a sponsor with the enough cash flow to bankroll your deal and the size of the deal, right? It's also risk to the sponsor, the KP, if they're contributing, call it 50% of the equity that's required. So it probably makes sense for them to spread the risk at that point as well.
Absolutely. And the other beauty to that too is like you get to serve. Now there are some people that want to do deals on their own. The thought of like having other investors and other people on deals like is bothersome to them, and that's okay, right? It's fine. But to really scale and accelerate, you leverage other people's money. And well, I think I was one of those that was very, very skeptical about raising funds from other people to buy deals. My first real estate deal, I saved funds. My brother and I went and bought it, and that's what I intended to do. But what I heard a mentor tell me that this line, which I take to it in everything I do, is like the fastest way to get what you want is to find other people that want exactly the same thing and give it to them. So how that applies to our business is like, if I want financial freedom, I find other people that want financial freedom, and I give them an opportunity to earn that, to get that financial freedom, which is the assets that we provide. And by doing that, I'm able to gain financial freedom myself. So the path to wealth creation or making money it's all about value creation, right? You can create that value, use your own money and create that value by yourself by buying this building and renting out to other people. Or you could create the value for many other people to bring them in the deal, and that allows you to go and buy 2, 3, 4 more deals and do that at a much faster scale. So I enjoy that part. I enjoy serving people. I enjoy bringing this value to people. I enjoy being able to sit back, and push that button to send distributions out to our investors. That's like that. That's my best part. That's my best part. Yeah.
Yeah, that's a great feeling, both for, I'm sure, you as well as your investors, right? Like,
Yeah,
to see that monthly cash flow.
absolutely, yeah.
Have you looked outside of, or maybe have your investors asked for asset classes outside of multifamily? So I know some syndicators, Open Door Capital and others, have started looking at not just offering multifamily, but like there's debt income funds for those investors that want that steady cash flow. Because a lot of multifamily, what happens is it's a 5-year deal, right? And you might get cash flow in like years 1, 2, 3 or so, but the real crux of the profit comes at year 5,
At the
right?
end,
Or
yeah.
whenever you sell, it could be year 3 or 4 or 5. And so to level out the cash flow for their investors, some syndicators have gone out with debt income funds and said, let's allow our investors to invest in these type of funds to give them the opportunity to level their cash flows, especially for retirees who want to see that cash flow. That's much more important to them than maybe the profit at the end. So have you, or your investors, have you thought about doing something like that?
Yes, we've had our investors ask about different things, not just debt funds, storage, all these other interesting ideas that usually come along. But one of the things that we believe in is like focus, right? Our goal is like really to focus, master one area, become really, really good at it. Yeah, at some point we're gonna get into other assets. One of the natural progressions that we're probably gonna get into is like development, doing build to rent. We have a mentor here in Maryland. That's like the one of the biggest developers here in Maryland that we're looking to work on the project within the future, but it's still multifamily, still built to rent communities and stuff, still along those lines, right? So it still has the same issue where most of the gains come towards the end of their appreciation. But like our goal right now is to focus in this space, master it, continue to master it, build a robust team that can, like a machine that can continue to run and push and go forward. It's just this year that Tenny and I exited and we're full-time on this. So we're building that back-end machine. So maybe in a couple years from today, we're going to be exploring those other avenues, but we remain focused on multifamily right now.
Okay. Question came in, what is the range of expected return of an LP in your experience? And is there a standard minimum investment amount of most syndications? And my experience has been 50K is the standard minimum amount of investment. Expected range. I know I have expected ranges that when we look at investments and we try to underwrite those investments, we have that range, but from a syndicator perspective, what are you looking at?
So for our investors, we project anywhere from 14 to 18% average annual returns. And we tend to be extremely conservative when it comes to the projections, because our philosophy is like we rather under promise and over deliver, because we can look at a deal and there's a justification, there's a story that we could use to sell that deal at 22% IRR or 20% IRR. But that is a situation where almost everything goes right, right? And one of my favorite philosophers is Mike Tyson, and he said everybody has a plan until they get punched in the face.
Yeah, that's right.
And trust me, in this business, you're gonna get punched in the face so many times. So we tend to be a little bit more conservative. So our projections are usually anywhere from 14 to 18% average on our return. But our historical returns that we've delivered to date is 29.97% average on our return. So if I promise you 15%, then at the end you get 30%. You know, I'm going to be your favorite person. So we tend to be very conservative. Yeah.
That's great. Yeah, I mean, I think that's part of what we're looking at as well. Historically, we've seen, I would say, like anywhere from 20 on up, right? With like 1.5 to 2x equity multiples.
Yes.
Those are like multifamily returns. When you get to like debt income funds, they are vastly different just because of the cash flow implications. Like they're meant for cash flow, and so they're anywhere from like 10 to 20% cash flow, which is great for a debt income fund. If you're looking at investing in your bank, a CD, that's like 4 or 5%, 4, 5, 6%, right? So to be able to get 10 to 20% on a debt income fund, that's great. But it really depends on the asset class, right? And it depends on the syndicator. Some syndicators are very, very aggressive. And as you say, they're not conservative in terms of how they underwrite, and that might get them into trouble later on. They might overpromise, underdeliver. Whereas I love the syndicators that are very conservative in their mindset, and they overdeliver on what they promise.
Yes, that's correct. That's our approach, and so we rather be conservative and do much, much better for you than the opposite.
Yeah, that's great. In terms of investors that are just starting out and thinking about asset classes outside of traditional stocks and bonds, how much should they be considering multifamily real estate? And should they invest in a REIT, or should they invest in with a syndication? And then like what are some other considerations besides maybe the returns? Obviously like taxes, right? Tax implications. Being able to invest out of a tax deferred account, self-directed IRA account. What are some of those considerations that they should be thinking about?
I would highly, highly, highly recommend that multifamily investment should be part of your your investment strategy. At least invest in one multifamily deal every single year. This is what I because I'm a CRNA by training. This is what I tell my CRNA colleagues. I highly recommend that at least invest, once you identify a good sponsor, invest at least in one multifamily asset every single year. right? Because once you start exiting, the compounded returns that you get over time is going to accelerate your path to retirement. And like you mentioned, it's not just about the returns that you get. You also get the tax benefits. You get the cost segregation, which gives you some depreciation, which you could apply to any passive income, right? And then if you are like a solo entrepreneur, 1099 employee, you could do a solo 401k or self-directed IRA. You could roll over all retirement plans to a self-directed IRA and invest in these assets. So REITs are not the same thing as investing in like actual assets and becoming part of the ownership group of these assets. We actually got approached this time by a REIT, right? That was looking to come in as an LP partner for one of our deals, because the REITs, most of them do not actually manage the deals. They work with other sponsors. They bring in the capital. So let's say for a REIT might come in and bring $10 million to our deal. They get
a REIT is a real estate investment trust.
Real estate investment trust. That's correct. Yeah. So a REIT is a real estate investment trust. Like a REIT might come in and bring in maybe $10 million to one of our deals, and they get maybe 18% average on our returns on that. And you as an investor in that REIT, when you're buying those shares on like you trading and buying shares in the REIT, you might end up with maybe 8, 9, 10% return on your money. And then the REIT owner makes the difference. So why do that when you can invest directly in the assets and get all the benefits and stuff like that? So I think a lot of it is a lack of education. A lot of us are very well educated in like traditional real estate investment vehicles like stocks, ETFs, funds, and all of that. But these private investments exist, and they've existed in a long time, and a lot of investors take advantage of them. And even some of those funds and stocks, they use some of their money and they invest in these assets. Like a lot of the larger apartment complexes, the $100 million, $200 million buildings, are owned by ETF funds. Like they're owned by insurance companies and all these other funds. And that's the way they're able to make some of that money to give you the returns that you're looking for. So I highly recommend investing in multifamily. At least add that as part of your strategy, even if it's just one deal a year that you invest in.
Okay, great. Thank you. We are at the top of the hour, and I want to be cognizant of all the attendees. If you have any other questions, feel free to drop in here. Leslie, any parting thoughts from you?
It has been such a pleasure being part of your platform again. Thank you so much, and thank you, Kesha, for inviting me to come share my experience with your group of wonderful minds. My name again is Leslie Awasom, and our company name is XSITE Capital Investments. We have created a community of other busy professionals that are looking to grow wealth, whether it's in real estate or starting a business. It's called the Beyond 9 to 5 Club. If you're looking in that direction, if you're looking to learn more about alternative assets or looking to invest in any one of our deals, you could find us. I think it's the Beyond 9 to 5 Club.com. You could check us out over there. And if it's okay with you, I could just share a QR code if anybody wants to scan it and reach out to us.
Yes. Please do so. And if they wanted to reach you on XSITE, how would they do that and see your latest investments?
So our website is www.xsitecapital.com. Or even like in the 9 to 5 Club, we have our latest deals over there. But our website is XSITEcapital.com. Our latest deal is a 268 unit deal in Atlanta, Georgia. It's still open. We still have a few slots left for some investors. So if that piques your interest, you want to learn more, reach out to us. We're more than happy to walk you through the opportunity.
Perfect. Well, thank you again today for all that you've brought. A lot of great insight, not only into how you transition from single family to multifamily, but also your buy box, how to be conservative as a syndicator, and as really an LP investor. I think that a lot of great experiences and great insight that you brought to our team. All the information here will be shared both on our webinar as well as on our podcast, Investing in Generational Wealth. So please like and subscribe and let other people know about our podcast as well as our webinar. And if you have any questions, feel free to reach out to me at july@clivecap.com. I can go to clivecap.com for more information. But thank you, everyone. And until next time, keep investing for generational wealth.